can.
Awesome.
Cool. Well, it is 12 o'clock, so let's go ahead and kick things off today. First of all, thank you guys so much for joining us today. My name is Courtney Graham, and I help to run the marketing and people team here at Princeton Mortgage. We're really grateful that you decided to hop on this webinar with us today. Hope you brought some great lunch for yourself. I know usually we try to treat you guys, but kind of in light of the circumstances, just glad that you guys could join us today. In just a couple of minutes, I'm going to let Mark start sharing, and he's going to lead us through some changes that have happened in the mortgage industry recently in light of COVID-19 and kind of its overall impact on realtors and the housing market. So we're really excited to share this with you today. Again, we're going to try to make this as engaging as possible. So I will be, if you see a notification say that you have been promoted to a panelist, all that means is that you then have the ability to turn your video on. We'd love to see your face, engage with you. I will mute everyone, but if you have a question throughout the presentation, please feel free, unmute yourself and ask. Again, we wanna make this as interactive as possible. And I'm sure you guys have a lot of questions because there's a lot of changes that have been happening. So please feel free to share. So with that, I am going to pass it over to Mark. Mark is our National Sales Director here at Princeton Mortgage.
All right, guys. Hey, thank you so much. Thank you, Courtney, for the wonderful introduction. Thank you all of you guys for coming. I know everybody is busy. I'm going to try to make this fun. And for you guys, special thank you to everybody turning their camera on. I know it's a little bit scary when we all have a haircut that hasn't been touched by anybody in 7 or 8 weeks and we're not feeling our greatest about it. I know that I'm definitely not as fresh as I like to keep it up there. So, but I do like to see your faces and engage that way. And again, as Courtney said, please feel free to ask questions as we go. I'm going to tailor this really to just kind of at a level that I think, you know, people in the industry from a professional realtor or loan officer standpoint will be able to take on. But I also have to be honest, I don't talk to, you know, a ton of realtors on a regular basis about these individual topics. So if there's things you want me to elaborate on or things that maybe just aren't in your wheelhouse and you want me to touch on a little bit more, feel free to stop me. Because once I get on a roll, you know, I may forget to add in some of the details. So, you know, you'd be helping me out by giving me any sort of feedback that you can. I'd sincerely appreciate it. So as I'm sure you guys know that they're broader than just the direct impact of the coronavirus or COVID-19. There's been a lot of other indirect impacts stemming from this over the last couple of months now that have really impacted the mortgage industry as well as our ability to deliver mortgages to our customers. And so that's what we're going to focus on and talk about today. I'm going to kind of go through some of the actual impacts as we go. And then at the end, I'm going to kind of talk about on a more broad level what's happened to the mortgage industry. And so that you guys can we can peel all that together and kind of see, you know, not just what the actual impacts are, but how we got here so that we can make some sort of an estimation or determination as to how we think these things are going to continue moving on down the road. And we'll give you a real macro sense of what the overall impact has been to the industry, because I do think that there are going to be continued changes coming forward. I don't think that we see all of it up to this point. Which, by the way, is a really good reason to push people who are on the fence to move forward now and get going, because I think we're going to see a lot of changes coming. So topics today, we're going to talk about forbearance. It's kind of the million-dollar word in the industry right now. Talk about what that means, what the impact of it can be, and that way you can continue to educate your clients. Changes to actual lending guidelines in terms of how we're looking in the industry at income. And by the way, these are not going to be specific to Princeton Mortgage. It's going to be kind of a culmination of what we're seeing industry-wide. To give you guys a broad look at what's happening throughout the industry and what options or things you might be looking for when picking a lender right now. Verbal verification of employment type changes, changes in the FHA and government lending space, FHA, VA, USDA loans, jumbo lending changes, and then updates to the appraisal process and the closing process. So that's kind of what we're touching on. And then overall at the end, we're going to get really into just how the mortgage industry as a whole has been impacted, which is driving a lot of these changes. So If you guys know about forbearance at all, it came from the CARES Act, which was initially passed by Congress in order to provide relief as an emergency aid package during this time period. So there's some confusion about this, and it's caused a lot of pain in the industry, mainly because while it does say that you have to have had an adverse impact to your economic situation from the coronavirus, it doesn't say what that means or that you have to prove it in any sort of a way. And so we have basically two separate options here, and borrowers who are looking to learn about forbearance can call their individual lenders. First, all loans through Fannie Mae, Freddie Mac, FHA, VA are eligible, or held by Freddie Mac and Fannie Mae are eligible for this. It's about half of the loans in the industry. In addition to that, all of the other private mortgage servicers have been strongly encouraged by the CFPB to do this, and for the most part, I think all of them have to some extent. You can request either all of your mortgage payments being paused or partial pausing of mortgage payments for 6 months initially, and at the end of that 6 months, potentially another 6-month period. But there's some things about this that I think are really important to know. First is your payments are not forgiven. Okay, it's not like they just go away and evaporate and everybody's good with not collecting that money. So part of a normal forbearance agreement in the past is that you start paying a higher amount monthly once you start paying payments again, in order to catch up on the payments that you've missed. There may be some other options with lenders in this case where you can tack those balances onto the end of your mortgage, but here's what we definitely know. We know that people will be able to get into this program without proving that there's any sort of hardship. There's no paperwork you need to provide. There's only about 4 or 5 questions lenders are even allowed to ask in terms of what hardship constitutes. We know that you're not going to have late payments attributed to your credit report, but that doesn't mean that a lender is not going to be able to see that you entered into this forbearance agreement or that you had a gap in your payments over the course of the 3 months, 6 months, 12 months as it might be, that you weren't making payments. And I think it's pretty naive to think that lenders are not going to consider that information on a go-forward basis when they decide who to lend to. Obviously, in a time of stress, if people were unable to make their payments, we don't want to take anyone's houses, we don't want to foreclose, but it's nearly impossible to ignore that when making an educated credit decision going forward. And so one of the things I always, mortgage guidelines sometimes make more sense than others, but when there's times of crisis like this, what you're going to see is a default to what we call logic-based underwriting. And so it's not going to be just guidelines or what's in the black and white. Companies are going to protect themselves from making decisions outside of what's in the black and white by having what we call extra overlays. It's very likely that those overlays are going to include taking a look at gaps in mortgage payments in the past, even if they weren't reported as technically late. So while it shouldn't impact necessarily the score of someone's credit, it may impact their ability to get mortgages in the future. So the first thing that I'm telling everybody, and also that if you look at the Consumer Financial Protection Bureau's website, the first words on this are, if you can make your payments, you should make them. And that's the first thing that you should be suggesting to your clients or somebody that you're advising in this. This is for people who have no other options in terms of making their monthly payments. One of the other things that I didn't see anybody talk about with forbearance is that the entire idea of a forbearance agreement in the past has been that, yes, you give somebody an opportunity to catch up if they were missing payments, but also as part of agreeing to the forbearance, you actually agree that it's easier to foreclose on you if you don't adhere to the new terms of the forbearance agreement. So for instance, it's very likely, and again, I have not seen this defined anywhere, we're kind of flying by the seat of our pants, but it's very likely that if you decide to start making payments again and agree to that new higher monthly payment in 6 months or 12 months when things get back to our new normal, if you miss a mortgage payment, it may make it so that the lender in that case can accelerate the foreclosure process differently than they would be able to if you never entered into a forbearance agreement to begin with. Traditionally, that's how forbearance agreements have worked. I have not seen a lot of specificity specifically to this, but we can assume that lenders are going to protect themselves in any way possible with this, because what we'll talk about more at the end of this is kind of the consequence to the whole industry of people deferring their payments. But for right now, I just want to explain how this works, which is that money is not forgiven, it is deferred. There are going to be several options for how people can pay it back in the term, and that right now it's an upfront request for 6 months and then an option to renew for another 6 months, 180 days from the initial request. They've also suspended all foreclosure proceedings for a 60-day period starting, I think, March 16th, so through the middle of May. But I expect that will get extended as we see more versions of the CARES Act pass through Congress and we see more things that evolve through there. So I think that all foreclosures will be on a moratorium for a long period of time. Not to just mention that your local courts are closed anyway, so that even if someone did try to proceed with this, there is nowhere to go to try to proceed with that process anyway. So all of that is on pause. Questions about mortgage forbearance specifically at all? Anything that you want to engage on in that either hasn't been clarified for you or that you guys have questions on? I'd love to open it up to anybody who might have something to ask about that. Cool. I think it's pretty straightforward, but if you think of anything, you can definitely chime in. So again, the advice you get to your clients is, yes, if you can't make your mortgage payments, call right away, because the wait times of these lenders are long. The line is long to get into these forbearance agreements. If you don't think you're able to make your payment, call right away. If you have any alternative to be able to make your payment, take it. So in terms of just lending specific guidelines to the mortgage industry, what are we changing? Well, every lender is taking a slightly paranoid approach. When I say that, though, I don't know if it's really paranoia if getting it wrong can kill you. And I do think that you're going to see a lot of mortgage companies go out of business at the end of this period here, and really even over the next couple of months, and I'll explain more about that why. So what you're seeing is a very defensive posture from mortgage companies as we go forward here into this uncertain period. What that means is more logic-based overlays when it comes to income, verification of employment, as well as specific changes to FHA, VA, and USDA loans, and changes in the jumbo mortgage market. And I'm going to talk a little bit about why those things are. So basically, when I talk about logic-based underwriting, what I really mean by that, guys, is that lenders are going to want borrowers to have skin in the game. So even more likely to determine defaults than just normal credit scores or how much money has in the bank is oftentimes the loan to value or the amount of equity that somebody has in their house. And so what you saw with programs like FHA and people who traditionally use FHA, you can actually only have to put 3.5% down. But then you can also get gift funds from somebody else for that 3.5% and get a seller's concession to cover your other costs. So oftentimes that people are getting into FHA loans, they actually have none of their real own skin in the game. And so that's what makes those borrowers much more likely to default in a situation like this, because they don't have that equity that sweat equity that they built, or that equity in the game that makes them less likely to default. It also makes it harder for them to sell that house in a pinch because they don't have that equity that they built up as well. So again, logic-based underwriting, we'll talk a little bit more about that as it relates to these specific programs, and we'll go through it. So again, these are not guideline changes that are specific to Princeton Mortgage. In fact, some of them are not exactly how we're addressing some of this stuff. But as we have a multitude of investors that we sell to, as well as being able to sell directly to Fannie Mae and Freddie Mac, we've compiled a bunch of things that we're seeing as trends. And I just want to explain these as you see them, so that these are things that you can be aware of with your clients and convey to them. And also, again, it's not just enough now to get a pre-approval and use that pre-approval from 3 months ago or 4 months ago or 6 months ago and feel good shopping for a loan. Over the last 3 weeks, these guidelines have gotten tighter and tighter and tighter from lender to lender. And so each week I would be rechecking in with whoever your loan officer is to make sure that your borrower is still approved before you're putting an offer in. And you need to know throughout that process, if you have a long process for your closing, right? So in other words, you're putting an offer in today, but we're going to close from 3 months from now, you can expect that there might be other changes that happen intermittently there. And so it might not be enough just to qualify right now, but to keep these things in mind as you go forward. I don't say it to scare everybody, but just so that everybody's going in eyes wide open. So particularly if you're self-employed, for self-employed borrowers right now, many companies are looking for verification that the business has not been adversely affected by the coronavirus, right? Which sometimes can be hard to prove. And even if it hasn't been directly impacted, they're going to take 25% off the top of the income that they would normally be able to use. So let me give you an example. You're a realtor. You guys are self-employed. Let's say your gross commission last year was $200,000. After write-offs and all the other expenses of being a realtor, you pay taxes on about $120,000 in income, so $10,000 a month. That's the amount that we would usually be able to use for your income. Usually we're looking for a 2-year history, and we're going to average your last 2 years together, particularly if last year was better than the year before, which for many people in your industry is the case. So we're using that $10,000 a month. Now what we're saying is we're only going to use $7,500 a month, and you're going to have to qualify using that lower number. So what that is that we don't know exactly what the impact to the real estate industry is going to be from the coronavirus. I saw an article today that said they expect a 15% drop in closings. I think it's going to be probably market specific. I think, northern New Jersey is probably going to be affected much differently than Charleston, South Carolina. Northern Jersey is my old home. Charleston, South Carolina is my new home. So, it's going to be market specific, but overall they're expecting a 15% drop nationally. We don't know how that's going to impact people's income. On a self-employed, we're going to take a defensive posture as a mortgage company by cutting that by 25%. Okay? So we are also going to be looking, when we talk about logic-based underwriting, one thing that makes somebody significantly less risky is having assets, right? And so oftentimes we're looking for assets in a mortgage, especially for a purchase, just to make sure that we're verifying where the money's coming from for the down payment. Here, it might make sense in a number of cases for you as a borrower right now. Maybe you were going to put 20% down. Maybe it actually makes sense to only put 10% down and keep money in reserves, which would make our underwriters more comfortable with the fact that if you did have some sort of income interruption, you'd have that other 10% to fall back on. So while you might have a slightly higher monthly payment, right, you would have more reserves in case of an emergency. And now we're at a time period where an emergency seems imminent or more likely than normal. So some of the normally what we're looking for is the best down payment wins, right? In terms of our overall risk capability. Here, it's going to be a combination of skin in the game and reserves. And so, we had a borrower last week, for instance, that I was working on here, where it did not meet our new qualifications if the person put all of that money down, but if they put less money down and they had reserves, it did still meet our qualifications. So it's interesting how there's some moving parts to this. And again, working with a mortgage person who, you guys have, I'm sure, met lots of mortgage people. Some people in the mortgage industry do a much better job of staying on top of these types of changes than others. You want somebody who's really paying attention right now and making sure that they're keeping everybody informed of the changes and are educating themselves on those changes as they come up. We're also going to be looking at to see if the business is closed. So my underwriters have taken to being Google search warriors. If you tell me that your business has been unaffected by the coronavirus, but it's 3 o'clock in the afternoon on a Wednesday and your restaurant is closed, and it says so on Google, we're going to need some sort of a letter of explanation for that or how that's individually working. There's a ton of people we're seeing our underwriters go above and beyond from the normal traditional ways we verify different things and being creative in terms of being able to try to verify that doing this loan is safe. So these are things to keep in mind with somebody. And by the way, that could be just not their business, but maybe a business they work at, right? And so these are things that we're going to have to keep in mind as we go forward. Just because your business wasn't affected so far doesn't mean it won't be. Or again, maybe you're able to work from home, but we don't know how working from home in your business is going to impact your ability to earn money, right? Especially if you're like a commission-based employee. So these are all different factors. For each individual situation is going to be a little bit different. And so that's why it's so important to keep checking in for your pre-approvals and making sure that your lender is factoring in this new world into their pre-approval for you and making sure that the borrowers still qualify. Again, 3 months of reserves and a debt-to-income ratio not exceeding 40 is kind of our new standard for someone who is part of a business that's technically closed but is still receiving full pay. Maybe it's a company that's paying their employees not to work at this point to stay on board. We need 3 months of reserves and a debt-to-income ratio not to exceed 40. Normally, that's 50 is our cap for our back-end debt-to-income ratio. If the business is closed and someone is receiving less than full pay, the borrowers must qualify off of the lower income, also be below that 40% debt-to-income ratio. And we're looking for 6 months of reserves in this case because, again, just because your company furloughed you here and is paying you 75% of what you made before doesn't mean that will continue for the long haul. Any questions about any of those things, or does that make sense? Cool. If the business is closed and the borrower is not receiving pay, the loan cannot move forward until the business reopens and the borrower returns to work. I'd also like to say that that is not an instant process. It's likely that your client in this case would have to be back at work long enough to receive a full paycheck from their job. So if you have somebody that's in that waiting pattern, it's not like, hey, you're back to work one day and we're going to get that loan closed. We want to verify that person's still making the same amount of money hourly, that they're working a full schedule, and we can usually do that with one pay stub. A lot of those decisions will also be made on a case-by-case basis, which is, we do not like operating in the mortgage industry in a case-by-case world. This is all uncomfortable because we want it to be black and white. If it fits this box, we're good. That's our normal operation and how we do things. Right now, there is no box to put these people into. Every situation is going to be looked at uniquely. So again, if somebody has $300,000 in the bank and maybe they don't meet some of those other criteria, or they're only back at work one day and we get a verbal VOE saying the company plans to be open for the future, we might accept that person versus somebody who doesn't have any money in the bank and is relying on those paychecks in order to make those minimum payments. Income qualifications. Another piece of this that I think, and by the way, one of the things, so another piece is the end of the process where we do our verbal verifications of employment. So this has always been the case that basically if someone loses their job the day before closing, the lender is on the hook for that. Even so, let's say we deliver that loan to Fannie Mae and they buy it from us. If it turns out that that person lost their job the day before closing and we didn't know about it, we as a lender can still be on the hook for buying that loan back from our investor pools. So there's always that risk. Normally, we want to make sure that we're verifying employment within 10 days of the loan closing. We'll do our final verification of employment. Almost every lender I've spoken with, including people who sell direct to Fannie Mae and Freddie Mac, are now verifying employment within the final 48 hours. This is difficult for a number of reasons. One is we're not just looking for a normal verification of employment or something that you can get through the work number as an instance, which is an automated employment verification. We're looking for a specific note from somebody's boss or employer that says they directly do not expect this person's income to be impacted by the coronavirus. If you work for a huge Fortune 500 company or a global company, they may have specific rules against bosses being able to do these things. And so sometimes we're asking people to do things that are a little bit uncomfortable, but I can promise you that no matter who you go through for a loan right now, everyone is going to require some sort of documentation from the employer that they expect that person's job to continue for the foreseeable future. What also makes this harder is that because people are either not working or working from home, people might be furloughed, finding that person's boss or being able to get a hold of them so they can send this letter, or maybe they're working from home and they don't have a fax machine there, or a way to scan something into their computer can make things more difficult. So one of the things we've asked all of our loan officers to do is proactively figure out who can do those verifications of employment for us to the end of the process and give that to our closing team in advance to make that easy. So it's one of those things as a realtor that you might be able to help out with, which is like, hey, do you have somebody at work that you work for, or your direct supervisor, who would be willing to verify for you that the coronavirus isn't going to impact your job? Maybe start having those conversations earlier in the process rather than later, because as the mortgage lender, we're only going to find out at the very end. And if they have a boss that won't do it or they can't get that information, it might make it so that we can't close the loan. Questions about verbal verifications of employment or why we are doing those at the very end. One of the things that I think you'll find is that typically lenders are underwriting to the idea that we can sell loans off of our warehouse lines or that we can sell them to large investor pools. In environments like this, something that comes up again is what we call forensic underwriting. So what happens is if these borrowers, if they meet every normal requirement that you would normally see, and we get almost everything right in a loan, the borrowers can make their payments for 6 months, 12 months, or 12 years. But once they default on their mortgage, their team will go back and look at 130 or 160 different points of things that we might have made even the smallest mistake on. And even if that person paid on time for 10 years, 12 years, and even if we got basically everything right, if we forgot to dot an I or cross a T, we can be on the hook for buying that loan back. Now, a typical mortgage company that does even $100 million in loans a month may only have a net worth of $4, $5, $6, $7, $8 million. So if you get a couple of these buybacks and you don't have anywhere to place those loans, you can see it can put those companies in jeopardy. So so again, a company that's lending $1 billion a year in mortgages may only be worth $5 million, and some of that much of that might not even be cash. So the idea of these buybacks are very dangerous, which is why you're seeing the lenders taking this defensive posture. Any questions about any of that? Anybody tired of hearing me talk yet?
If you guys just have a question, you can always just make sure to unmute yourself and speak up. We'd love to hear from you guys.
Yes, absolutely. So, FHA lending. Okay, Arthur, do you have a question? You're muted.
I'm sorry.
Yeah, go ahead. I think you remuted.
Here, I just unmuted him.
Are you there? Can we unmute? Arthur, we can't hear you. If you get unmuted, shout out your question. I apologize there.
There you go. Now
go ahead, Arthur.
All right.
What's going on?
Can you hear me now?
Yes.
I can.
When you
Thank
say
you.
buyback, you're talking about Princeton mortgage closes, creates a mortgage on behalf of a customer. Then you sell it to a larger corporation. And
Or even Fannie Mae and Freddie Mac directly. Yep.
okay, but because of situations, then you're sort of forced to reclaim that mortgage.
Right. So again, even if that mortgage has
If
been
the mortgage
performing,
would be forced to reclaim that mortgage.
right. So technically, so the way it works is if we did everything right, then we would be off the hook usually after 6 payments. But if we did anything wrong, we're on the hook forever. And when somebody's desperate because they have a bunch of loans that aren't performing, even Fannie Mae and Freddie Mac, that desperation leads to them spending lots of money for very expensive people to find something we did wrong so they can send that loan back to us. And so even if you do a really good job with this stuff, mortgages are moving parts and living, breathing things almost up to the very minute they close. And even a small mistake can become a big deal if someone doesn't make their payments down the line. And so in environment, now listen, if 1% of the industry is defaulting, not that big a deal. If that becomes 5% of the industry, changes the game in a big way for those servicers, and they start to spend a whole lot more time, energy, and effort finding reasons to send those loans back to companies like ours. And most of the mortgage industry is non-FDIC insured bank lenders, right? So whether that's Quicken Loans, which is not a bank, but is a huge lender, or United Wholesale Mortgage, which a lot of small mortgage brokers send all their loans to. All of those companies are in the same boat when it comes to that, and none of them are liquid enough to endure a large percentage of their loans getting sent back to them.
Okay.
That's a great question. So any other questions, guys, please shout them out. It's my favorite part. I get tired of hearing myself talk too. So FHA loans have been a really great solution since the 2008 financial crisis for many people. It allows you technically to go down to 500 credit scores, or almost all lenders down to 580. As I said, you can get your down payment as gift funds. You can take 6% seller's concessions to cover a bunch of the cost. And traditionally, they have lower standards when it comes to debt to income ratio. You can actually have 57% of your gross income going out the door just to the bills on your credit report and still get approved in many situations. So unfortunately, that also makes this group the most vulnerable to default when things go wrong. They have less skin in the game and riskier credit profiles to begin with. And what's really compounded the issue right now, and what actually has the whole industry in jeopardy, is that FHA and VA loans are sold securitized through Ginnie Mae. And so what that means is, in order for us to create liquidity in this secondary market where it's easy to buy and sell loans to many different people and we have consistent pricing, we sell these loans in bulk through Ginnie Mae. Now, the way Ginnie gets a bunch of people to give them the money to invest in these loans is they guarantee payment. So that means if I'm a servicer of an FHA loan and my borrower doesn't pay, I still have to make that payment to the securitization pool. And then eventually I can get that money back either by foreclosing on the home or from the FHA insurance pool or the VA insurance pool. But that can take years to go through that process. What's happened now is with the forbearance section of the new regulations, right? So we have this forbearance for the new regulations. We may have 10% of the industry, of the country, not make their mortgage payments this month. Well, if you're Quicken Loans and you're holding $8 billion in FHA loans, and you have to collect those payments, and now you have to make payments for the 10% of your client base that didn't make their payments this month, you're looking at a huge liquidity crunch. So because of that, no one on the secondary market wants anything to do with FHA or VA loans right now. They're not buying them, right? And so in addition to just lenders trying to protect themselves, we no longer can make any money on the secondary market selling these loans because nobody wants the servicing. In fact, the servicing value, which is the money that the value that people place on being able to get paid to collect mortgage payments each month, is negative right now on FHA and VA and USDA loans, which means I'd actually have to pay you to take these loans from me, which is a very different scenario than normally. Normally, people are willing to pay 3 years of the fees they get to collect mortgages. It's for the right to collect mortgages. Now they're saying, hey, if you want to send me those loans, you have to pay me to do it because the risk is too high right now. I'm not liquid enough to make these payments, and I don't know what the government's going to do to protect me. So what that's really the end result there is that FHA lending guidelines have gotten so strict right now that oftentimes it just makes more sense to go conventional. And even if you have no other options, like you need the down payment assistance or you need that 6% seller's concession, you probably have to have a really high credit score, and the borrower may have to bring some extra money to closing to cover the cost, because we are not getting anything when we go to sell those loans on the secondary market. So for the moment right now, FHA is kind of on pause. If you have to do an FHA loan, I recommend you make sure, and by the way, Princeton Mortgage does not sell directly to Ginnie Mae. We do for Fannie and Freddie, but not for Ginnie. I recommend if you're doing an FHA loan right now, you should probably find a lender who can sell directly to Ginnie over the next month or two, because they're going to have a little bit more flexibility on that secondary market in terms of what they can or can't do. Not always the case, and you certainly shop around, but look for Ginnie. You should be only using people for conventional loans right now that can sell direct to Fannie and Freddie. Conversely, for FHA and VA, it does make sense to work with somebody who does Ginnie, and we're working on that at Princeton Mortgage here as we speak right now. So there's only one lender I know of in the country, by the way, that sells direct to all three and also doesn't have servicing exposure on the other end. So one of the other advantages at Princeton right now is we don't service. So we don't have any of that back end exposure we were just talking about. Most mortgage companies that sell direct to Ginnie have that back end exposure. That's another thing you want to consider when you're picking your lender right now. I'll talk more about that at the end. Jumbo lending, it's pretty much dead. So jumbo lending post 2008 never really came 2007 really never came all the way back. In 2007, we just talked about those securitization pools. 61% of all jumbo mortgages, which are mortgages that are lent over $510,000 in most areas, or $765,000 in some high cost areas like northern New Jersey, Washington, D.C., and some other areas, are these jumbo mortgages. In 2007, they were basically all securitized. Over 60% of them were set up in securitization pools, same way that we just talked about Ginnie and Fannie and Freddie, so there was liquidity. After 2008, it's only been about 1.8% of jumbo loans that have been securitized, which means that lenders are lending that money with their own money and holding those loans on their own books. So it's created a lot of illiquidity in the market. Now, what's saved jumbos up to this point is that since 2008, there's basically been zero default rate on jumbos. It's 0.04%, which is incredible. The best performing mortgages ever written in the mortgage industry are these prime jumbos. But in an environment like this, we expect things to happen. Lenders expect two things to happen. One is the first home prices to lose value are these jumbo home prices, houses over $1 million, because a lot of people aren't making luxury home buying decisions when the market gets tight like this. The second thing is a lot of those borrowers have a lot of exposure to the broader market, so losses in the stock market. A lot of them are self-employed, have their own businesses. So we expect default rates to go up on jumbo loans. When you combine that with no liquidity because there's no securitizations and people are lending their own money, people have really just stopped lending jumbo money right now. Your best bet for these loans right now is going through like a local bank or credit union where somebody is willing to lend their own money and has some sort of a relationship with that client. For instance, even Wells Fargo right now to do a jumbo requires you having $250,000 or more in assets parked with Wells Fargo, or they won't do it. So in other words, in order for these banks to feel safe or feel like it's worth it to risk it, they need to be getting money off of your other assets as well. That's just where we are right now. And I don't expect the jumbo thing to turn around nearly as fast as the FHA thing. I think FHA will turn around more quickly in the next few months, but this jumbo thing may be here to stay for the rest of this year and potentially into next year. Questions about any of that? Okay. I might start dancing just to keep you guys entertained if I lose you.
Hey, Mark.
So appraisal and title changes. So one of the things that I see oftentimes, or a mistake that I see a lot of loan officers missing in the industry, is that oftentimes, even for purchase loans right now, we can get appraisal waivers. A lot of people don't know this. If a property had a conventional appraisal done through a Fannie or Freddie lender since 2012, that appraisal got logged. And unless that is in a declining market right now, Fannie and Freddie will actually either use that value or even project out, in many cases, a higher value for that appraisal. And this applies to rate and term loans for refinances, cash out refinances, but also purchase prices, even when the person who got the original appraisal is different than the person that's getting this new loan. So the first thing you want to know when you're looking at a property, and this is something you can work with your lender on or ask your loan officer about, is if we buy this property, is it a property that we can get an appraisal waiver on? A, that takes care of some of the coronavirus worries. B, it can speed up your overall process. It can save your borrower a little bit of money and also take some of the risk out of the process of having cost secures or other things that might come up after an inspection. So look for appraisal waivers on the properties that you're getting for conventional loans on the purchase side. For purchases, we are now on our Fannie and Freddie loans selling directly to Fannie and Freddie, allowing for exterior only appraisals. So what that means is that we can do an appraisal without going inside the person's home. And for the time being, it's not a permanent change, but because of the CARES Act and the crisis with COVID, we can do an exterior only appraisal. So while the appraisal market is a little bit backed up right now because there's so many refinances coming in as well, and not everybody's getting these appraisal waivers, we should be able to, we should have eliminated basically the issues with appraisals for the time being in terms of being able to get loans closed. So this is a big concern when the coronavirus crisis broke. It looks like the industry has solved this one as we go forward. Traditionally, as you guys mostly know, we have interior home appraisals, that inspect landscaping, roofing, other things that can be cost secures. We don't have to worry about any of that right now, as long as the exterior of the home is in good shape and we can get a good value. Questions about appraisals? Closings. This one's a little bit more complicated.
Art, did you have a question?
I found that very troubling, I guess.
Which part?
Well, by a drive-by, how can you have any indication on what's going on in the interior of the house?
Well,
and the value of the condition of the interior of the house.
So that's a great question.
How can you make an honest assessment of what the house is actually worth?
So here's really the answer. So the first answer is obviously there's a bunch of factors that where you would say like, okay, there's things that we can't factor in here. There's changes that may have made the house. We may get this wrong. And I guess the short answer is we know that, right, going in. And so what we're saying is rather than halting the entire economy or exposing people inside of these houses to the coronavirus, we're saying the risk on getting this completely wrong is worth it. The reason being, by the way, is that we're kind of betting on the fact that our buyers are going to be smarter than to buy a house that they don't feel good about buying on the inside or they feel like they're not overpaying for. So whereas on a cash out refi, so you cannot do a cash out refinance with a drive-by. If I own a house and I want to take equity out, you have to let the appraiser in, put the hazmat suit on, figure it out. We're not going to let people try to game the system to take equity out of their homes. But if someone's looking to save money on a rate and term basis, well, as a bank, we're saying basically we already had the risk. Fannie and Freddie already had this risk. If the house goes bad, we'll let somebody get a lower monthly payment, actually reduce our risk and exposure without an appraisal right now. Or on a purchase, we have usually an inspection taking place, a buyer's realtor, sometimes a closing attorney, who are going to be all looking out to make sure the borrower is making a good decision. In this particular case, we're willing to take that risk. So I think that's what you're seeing right there. It's an educated risk, but obviously still a risk. And so you're right to have thoughts about that. But again, that's where we trust that you realtors are going to do a really great job of advising your clients to make sure they're not overpaying for their homes.
Mark?
Yeah.
I recently closed, actually yesterday, but they did a virtual tour appraisal in addition to having driven by, and it helped a lot. We were able to get it closed.
So that's an awesome point. And so this is something that, what state are you in?
New Jersey.
Awesome. So this is something we actually just looked into. There is no form. So the virtual inside appraisal is an extra step a specific lender may decide to take to protect themselves, like where Arthur just said, hey, how do you know? As an independent investor or mortgage company, we say we want to see the inside of the house. Here's our virtual tour. In terms of being able to deliver that loan to Fannie or Freddie or its value on the secondary market, they have not found a way to quantify that. In other words, you cannot use any of that virtual tour pictures, or even if it's somebody else inside taking a picture of their phone and sending it to you, you cannot use those pictures inside a normal appraisal report for like a cash out refinance, as far as I know. So
this was a new purchase.
Yeah, as a new purchase, right? So that would be like, it's an extra overlay that lender is putting on there for purchases or rate and term loans where we've already said we don't need it. And by the way, that's probably smart. But on a cash out refinance, you would still need to do and have somebody, the actual appraiser, go in and do an internal inspection for now. Great questions, guys.
We had a question come up actually from our Facebook broadcast. I think when you were talking about appraisal waivers, you mentioned that we could use appraisal waivers except in declining markets. So what criteria is used to determine a declining market?
It's a great question. And so it's something that we actually just looked into. There isn't a lot of clarity on that. And by the way, up until now, we really haven't had very many declining markets since this appraisal waiver process came into place. And so this is not something that we've really run into. It may be something that comes up because of the coronavirus at some point soon. Usually what you're looking for is just the median home price or the average home sale dropping in an area over the course of a significant period of time would be a declining market. How Fannie Mae specifically does these appraisal waivers, I have not seen an equation for, but I can tell you, like in my market here in Charleston, South Carolina, if you got an appraisal for $550 2 years ago, you might get an appraisal waiver for $580 or $590 today. They've just basically said like, hey, we think your house it has appreciated this much and we'll give you a waiver even above the value that you got. I've seen in some areas where that appraisal value needs to be dead on or lower than what the initial purchase price was. And so I don't have a lot of clarification on exactly what the Fannie Mae kind of concoction is for that, but it is something that your individual loan officer should be able to determine. And it's you can kind of guess and check with this as you run it through your desktop underwriter. Let's say you need 580 as an appraisal value. You can run it through a 580 and see if you get it. You can try it at 570 or 590 and see if you get the waiver. So there are things that we can do as a lender to continue to check and see what values are available to us in different situations.
Cool, thanks.
Awesome, thank you guys. Cool.
I have
So
a question.
sure.
I was trying to find the email that I received. I don't know if it was either from our broker or from CTAR. I couldn't find it. But anyway, it was saying something about pushing appraisals out even past like 120 days past closing. Have you heard about that? What would be the benefit of that? And what would happen if it didn't appraise? Like, I didn't really understand that.
Yeah, I'd have to see the individual email to know exactly what it is that they were discussing. It would make sense to me in this environment, especially depending on your market, to be concerned that home values might have dropped over a relatively short period of time. So normally an appraisal is good for 120 days. So that means, let's say I get an appraisal done today, we can close that loan for the next 4 months and use that same appraisal without getting any sort of a recertification on value. There is a chance that individual investors or even Fannie Mae and Freddie Mac will change that guideline to maybe a 60-day hump because they're worried about declining markets and the asset declining quickly. But I have not seen any anything specific on that yet up to this point. I'm just speculating as we move forward. So if you want to send that over to me though, I'll share my email with you guys at the end. I'd be happy to take a look at it and let you know what I think.
Okay, thanks. I'll
Thank
look
you.
for it and send it over to you.
Yeah, is it Inez?
No, I'm
go ahead.
Melissa.
Yeah, go
Hi,
ahead.
how are you?
Yeah, hello, how are you?
Good, good. Thank you for doing the webinar. I wanted to ask you regarding VA loans. Is it the same than the FHA that they're asking for now money? Because normally VA loans 0% except the funding fee that you
Yeah, it's a
can
great-
go into the mortgage.
It's a great question. So for VA, and by the way, lenders tend to try really hard to take care of veterans. No one wants to be the lender that cracked down on their veteran loan program, right? I mean, so we try really hard with that. I have not seen anything in terms of minimum down payments change for VA loans, but I have seen a lot of minimum credit score requirements change. And so people are usually requiring, 660 credit scores. Just so that you guys can kind of keep this in perspective, the largest warehouse bank in the country, when warehouse lenders are basically the big credit card mortgage companies like us use to fund loans before we sell them off from the secondary market, is Chase. Chase just made their minimum FICO for anything funding on their warehouse line 700. The second biggest warehouse company in the country, which is Tennessee, Bank of Tennessee.
First Tennessee?
What is it?
Is it First Tennessee?
First Tennessee just upped their minimum FICO to 670 for all loans that are funding on their warehouse line. So as you can see, those warehouse banks have a ton of influence on the rest of the industry, and so I think you'll see other people follow suit, which is that the lower FICO score borrowers, even if they would normally run through FHA or VA or even conventional down to 620, we might not be able to get those people approved or get loans done for them right now. And again, that's why having a lender who can do rescores or credit repair work during your loan process is another thing that you want to look into. Make sure your lenders are willing to work with you if your credit scores aren't perfect coming into the process.
So the minimum for VA loan then will be what?
It's very
The
lender
credit score?
specific. So it's very lender specific. I've seen some lenders say they're still doing down to 600 credit scores. I have a feeling they're just a little bit behind the curve. I've seen a lot of people up their minimum FICO score to 640. That's what we've done here at Princeton Mortgage. I've seen many others up it to 660 or 680. And again, if you're with Chase right now, you have to, no matter what loan program you do, you have to put 20% down and have a 700 credit score, or they will not do it. And they're one of the biggest lenders in the country. So these are great questions, guys. Thank you so much. Did somebody else have something to say? No? Okay.
No, I'm good.
So, yeah, so in terms of the closing process, this is also vary by area. Different counties are handling different ways in terms of recording. However, all of the big title insurance companies, as far as I can tell, and there's basically 5 or 6 title reinsurers who control this market, are allowing people to close, and then we will record the mortgages once the county recording offices reopen. So we have found a way around that, which is one of the major concerns when the coronavirus broke. Some of the other issues that we're still having, though, however, are many lenders have suspended the use of powers of attorney. Fannie Mae and Freddie Mac came out with a bunch of language of things they were looking for powers of attorney in order to make them qualify. Honestly, the list of things they were looking for to approve a power of attorney was so long that at Princeton, for the time being, until we had legal clarification, we just suspended use of all powers of attorney. So I think initially they were trying to help and create clarity. They did a pretty poor job of it, and most lenders I've talked to are no longer accepting powers of attorney in most cases. There are individual approval processes that you can go through, and I think some lenders are going to start to try to open that up as we get clarity, but that has been one hurdle we've had to jump through. We also, in many states, don't have the ability to do remote closings, and most lenders, in terms of the actual recordable documents, are not allowing e-closings, which is really sad that we're in 2020 and that's still where we are. Hopefully, in this case, this will be a case of necessity, causing invention, and people will pull this together and figure it out for the future. I got into the mortgage industry in 2005, and I've heard every step of the way that we were, just a couple months away from getting e-closings and having this all be a digital process. Obviously, we've made huge strides, but we haven't gotten there yet. But so in most cases here, and what most of our closers are doing right now, is kind of like giving somebody the documents, checking their ID, standing outside, having individual papers passed back and forth, and doing this sort of like halfway social distancing thing as we do closings. In Pennsylvania, they've had some confusing directives around this recently. I don't know if any of our realtors here are from Pennsylvania. We do, as a company, a bunch of business in Pennsylvania. We think that we're going to be good because we think that title companies are still going to be, or the closing process, I should say, is still going to be considered essential. But without it, in terms of actual title insurers and what the work that they can do, all of it's got to be done remotely. And so we're still trying to work through some of what the intent was in the confusing language that came out from the state of Pennsylvania around this. But for the most part, in New Jersey and South Carolina, where I am, that's kind of the process has been to do it, kind of in a social distancing way and be as careful as possible for the actual closings. So do you guys have any questions about that? And if not, I'll kind of give you just the whole picture as to where all this drama and sauce is coming from. All right, guys. So all of this coronavirus stuff has led to a bunch of different things that maybe we wouldn't have thought about going into this. One of the things that we did think about, or that seemed very obvious to me, is if we get hit with the coronavirus, mortgage rates are going to go down. And the reason is because people are going to be worried about the stock market. If you're a hedge fund as an institution or a country that's looking to invest its money, you can't keep it under the mattress or give it to the bank. So you have to invest it somewhere. And the safest place you can invest your money when assets are in trouble is U.S. Treasury bonds. And so those are normally the safest place you can invest money, and they have the lowest yields or return on investment. The second safest place you can invest your money traditionally is U.S. mortgage-backed securities. Even if there's a 5% default rate, which would be massive across the industry, it means 95% of people are still paying their mortgage every month. It's a pretty safe asset class. So in other words, mortgage-backed securities really just only have to have a slightly higher yield than treasury bonds in order to entice money into those securitizations. And I know some of this may be a little over some people's heads, but I think it's important just to kind of walk through it. So we know that rates are going to go low. In addition to that, when the economy gets real bad, the government decides to buy treasury bonds and buy mortgage-backed securities to push rates down even lower. So we prepared for a refi boom when all of this happened. We thought that rates would go down. We thought that would be really good for the industry. And to a large extent, we were right about that. Here's the parts that we got wrong. So the part that we maybe didn't initially consider is the refinance boom would be so big that all of those companies that just went out and bought servicing rights to their portfolios. So in other words, as I told you before, companies get paid by Fannie Mae, Freddie Mac, Ginnie Mae to collect payments each month. They will pay 3 years worth of those premiums for the right to buy those loans and service them in the expectation that they're going to hold those loans for 7 years and there'll be 4 years of profit. Well, all the loans they bought over the last 2 or 3 years are now getting paid off early because rates went down and everyone's refinancing again. So all the money those companies laid out for the rights to service those loans, they got hosed on. What makes that even more complicated is that those mortgage companies use the prospective value of that 7 years of servicing in order to borrow money to do other things. So not only are they not actually going to get that money now, but because that value has gone down, those mortgage companies are now, if they were using that money maybe for leverage on their warehouse lines, maybe their warehouse lines are getting cut. Maybe they're unable to meet their covenants with FHA and Ginnie Mae for the amount of loans that they're doing. And so we have this huge cash constriction in the middle of this time period because they're getting crunched on the servicing side of things for early payoffs. That's just one factor that mortgage companies are going through right now. Completely separately from that, because we told people with the forbearance they'd have to make their mortgage payments, and because the mortgage companies are still going to have to pay those securitization pools even when people don't, no one wants any more servicing. So in addition to that, people are already worried about the early payoffs. They're already getting hammered on that end. We have record volume coming in, so people need all their warehouse line capacity. And now what happened is the value of servicing went down so much that something called our hedge or our trading when we deliver loans for rates evaporated. So let me kind of back up and try to say it this way. When we say we're going to deliver a loan to somebody at a 3.5% rate, we're betting on where the market's going to be in 45 or 60 days when we go to sell that loan. Normally, when rates go down, we make more money on that. But we didn't make the money this time because nobody wants to buy the loans. So now the way we cover ourselves from that rate drop is to trade and bet on the stock market that rates are going to go up. Well, we got crushed on all those trades. This is the whole industry. This is everybody. We got crushed on all those trades that betting that rates were going to go up. And normally where we would make all our money back selling the loans for a higher premium because rates went down, we never got it because nobody wants to buy them. This is the first time in the history of the mortgage industry that there was a separation between the value of mortgage-backed securities and rates going down with what we were able to sell those loans for on the open market. That dislocation cost companies millions and in some cases billions of dollars. It's very likely that companies like Quicken Loans had to write $2 and $3 billion checks this month for the losses on the trades that they'll never get back on the delivery of the loans. So that factored with the servicing losses in the early payoffs, factored in with the fact that they were using that early payoffs for leverage on their warehouse lines, and they have more volume coming in than they know what to do with. And all their people are working from home for the first time. They have to deal with all that new volume coming in the door. And they have to make sure the technology and everybody else will all be able to work from home, right? All of those things factored in together. And by the way, like for instance, if you're Wells Fargo and you outsource a lot of your work to India, well, in India, the place where everybody goes to work has amazing internet. When those workers go home, they have no internet. So those guys can't work from home in a pandemic. So how do you service those loans? How do you get those loans closed, right? So we're all dealing with all of these different adjustments at a time period where the guidelines are changing and it's very hard to verify information. So we have a perfect storm right now in the mortgage industry. And so now many of your loan officers may not know any of this. Most companies don't share with their loan officers. They don't think they can handle the information. They're not transparent about the losses that they're having, or maybe they're so worried about they're going to go out of business and so they're really keeping things quiet. But when you factor in all of the losses in these different areas, like for instance, so Princeton Mortgage is only exposed to one of these losses, the hedge loss, which is our bets. We got crushed on those bets and we got crushed on the delivery of those loans. Every mortgage company did. Because we don't service loans, we actually missed out on the pain for many of these other things. And we also already had a staff of people that work from home for the most part. So those transitions were pretty easy for us. But for a lot of mortgage companies, they got blasted on multiple fronts. And so they're just starting to realize those losses this month, and they will realize them through the end of this month and into the first 2 weeks of May. So this is one of those times where it's really important to start asking questions to your loan officer about the communication they're getting from senior management in their company about the safety of the company, because it is very likely that companies are either going to become acquisition targets or completely go out of business over the next month or two. It's a confluence of all of these things. Inside the experts in the mortgage industry, this is not my speculation. This is out in the open. Everybody knows it. You know, if you guys have a chance to follow anyone on social media, I recommend Barry Habib. He runs a website called MBS Highway. By far the best information share of this stuff I've seen anywhere. And he does such a good job with it that you're seeing mortgage companies all over the country pay him to come talk to their teams because they don't know how to deliver this information. So I would recommend following him and getting information from social media. But some companies may not fully realize their exposure yet. I think a lot of them probably have over the last week or two. But this is a problem that's really bad right now, causing a ton of pain and getting worse. And what makes it a very unique situation in addition is normally when we go through a downturn or the mortgage industry loses money like 2008, we have less loans, so you can do layoffs, you can do other things to save yourself as a company. Right now, all of this is happening in the midst of having more volume than we've ever had before because of the refinance boom from rates going down. So no one even knows what to do or how to play it. And so the companies that are going to win are the ones that have fortress balance sheets that are mostly cash, and the ones that had the least amount of exposure to servicing in relationship to their total net worth. And so those are weird questions to ask your loan officer, and they might not know the answers, but it's definitely something you want to pay attention to here as we go forward over the next month or two. And it might make sense to have your borrowers get pre-approvals from multiple lenders, so if something does go bad, they have other options during the process. So that kind of concludes my mortgage industry perfect storm. I'm here to stay as long as you guys want and answer any questions. Thank you guys so much for coming, and thank you guys for being willing to bring your own lunch. Next time it'll definitely be on me, and hopefully we can do some of these in person. But I hope you guys found the information valuable, and like I said, I'd love to answer any other questions you guys might have.
Hey, Mark.
Yeah.
Thanks for the presentation. We appreciate it. Most of the stuff that you went over, you know, although very informative, was kind of negative. Are you seeing any turn anytime soon on any of this stuff, or how are you kind of forecasting what the next like 30 to 90 to 180 days would be, so we can all kind of prepare properly?
So if you want me to focus on some of the positive things, I'd be happy to. The first thing I'm positive about is it doesn't seem like people buying homes have taken a full-blown retreat. I see a lot of people still looking. I know in Charleston in particular, we've had a ton of activity in terms of listings and new offers go in over the last 30 days. So that's a really good sign. And for the most part, your well-qualified borrowers are still going to qualify without too much of a problem. So there's something to be optimistic about there. In terms of specifically about how the mortgage industry is going to be handled over the next 30 or 60 days, I am not optimistic. I think you're going to see more retreat. I think you're going to see more guidelines, more negative changes. And unfortunately, companies that aren't going to make it. So on the mortgage side of things, I'll be honest, I'm not overly optimistic, at least in the very short term. In the medium and long term, listen, we're in a commodity-based business. The market's going to drive these decisions, and a bunch of people are going to make it. Your loan officer is also always going to have another place to go. So whoever your favorite loan officer is, they may work for a different company, but they'll still be employed. The loan officers are never going to be hurting for work. So that's because they have you guys as amazing referral partners. So that's the good news. But you know, the news for the overall industry is, you know, bleak. It's going to be companies that have been very smart about these decisions, and again, are mostly cash. Otherwise, you're not going to be able to survive it. If your assets are tied up in a bunch of other things, or you know, you were investing that money in the stock market or other areas, you know, you may get burned. Great question. What other questions? I don't mean to be negative, by the way. I don't think anyone else is telling you guys this stuff. And so that's why I think it's so interesting, because it's all real, it's all out there, and there's just nowhere else there's so much other negativity clogging up our news channels right now. We can't even get to the negative parts of the mortgage industry. What other questions do you guys have?
Hey, Mark.
Yeah.
Hi, it's Grace Repka, New Jersey.
Okay.
I have a question. I missed a little bit on the forbearance part of your conversation. Are you saying it's a good idea? It's not a good idea? What like in general for the consumer?
Yeah, you know, it's so funny. So, you know, this is I'm lucky because when I think it's generally a bad idea if you can avoid it. I mean, if you can avoid it, you should avoid it. And I thought maybe that was controversial for me to say that. But if you go onto the CFPB website, it's the first line on their website too, which is if you don't need to do it, don't do it. We don't know what all the impacts will be. It's likely there will be impacts to people beyond just the obvious. It's not going to hurt people's credit score, but people are going to factor it into their ability to lend later. Their payments are going to go up. They're going to have longer mortgage terms. So it's really a last resort option, right? If you can find the money somewhere to pay your mortgage payment, you should do it. If you can't, don't get foreclosed on, apply right away. So if you can't make your payments, you should apply immediately. If you can make them, make them. Great question.
And I had one more question about the veterans, the VA loans.
Sure.
So if someone is a VA and they have the cash in their their account, I mean, what is the recommendation? Can they get a VA loan and put 20% down?
So it's funny. So whether or not a VA loan is the best option for somebody really is a confluence of factors. It comes down to credit score, income, and the amount of money that they can put down. And also, on their VA status, right? So if somebody is a disabled veteran and they have no funding fee, VA is going to almost always be the best option for them if they can get into that loan. If somebody's doing a second or third time VA loan and they're paying 3% up front in mortgage insurance fees, a conventional loan might definitely be a better option if somebody has the money to put down. But that's why it's important to work with a loan officer that's both familiar with VA and conventional loans that can give that individual customer the best advice.
Okay, because this guy is a retired guy, so that's why I'm asking. He's retired VA.
Yeah, it'll depend on what branch he was in, how many years he served, his eligibility for different benefits. So it's very specific to the individual client. But again, I think that's a great question. And, if you want me to take a look at that guy's individual situation, I'd be happy to.
Okay, great. Thanks a lot.
Absolutely.
Okay, just one question that I have is, it went quick and there's a few things to absorb. Is there any way that you're going to post this somewhere that I can listen to this one more time a little slower?
Absolutely. So Courtney, I'll let you take that.
Sure. So we do have the PDF materials that we can get out to you, and then we do have a recording that we will be happy to distribute to everyone on this call. If you want to go ahead and take a look real quickly at the material, we did do a live broadcast on Facebook too. So you could always head over to Princeton Mortgage, our Facebook page, and you can rewatch it there. We'll definitely be getting the materials out to you all as well.
Yeah, and again, all my contact information is also right here on the screen. Feel free to use it, reach out, email me, call me. My cell phone number's on there for a reason. I would be happy to answer initial questions you have. And obviously, if you're looking for someone to help you, connect you with a loan officer that's local to your area. Or a lot of you guys were invited here by a loan officer that already works for Princeton, so you can certainly reach out to them as well. Inez, what can I do for you? You're muted still. I can't hear you. You have to unmute.
I'll unmute her.
Oh, I'm sorry.
You're good.
Okay, now you can hear me?
Yes.
Okay. You said that there's a massive refi. That's because the interest rates are low?
Yes.
Or is it because it's safer for investors to invest in real estate?
Nope. Very simply, it's that interest rates are super low, particularly if you are in a conforming loan amount for your area, so under $510,000 nationally, or in some areas as high as $765,000. But if you're under 510 and you qualify for a good loan right now, the rates are either at or right next to the lowest they've ever been. We have people getting 15-year fixed rate terms in the mid 2s, 30 years in the very low 3s or around 3%. So it's, depending on the actual day, and it's still, the market's kind of moving a lot. This is the best time ever to refinance. Everyone in my company, including me, just refinanced their own personal home. So if we're doing it, it's probably a good idea.
Are they doing drive-by appraisal or not? Or what kind of appraisal are they doing then?
So for me personally, I got an appraisal waiver. I bought my house 2 years ago, and I didn't even need to get an appraisal. And in some cases, in many cases, for other people, it is a drive-by appraisal. As long as you're not taking cash out, you can get the drive-by appraisal. If you are looking to take cash out of your home, you would have to let an appraiser in. And we do have appraisers who are willing to do that work as long as you're willing to let them in the door.
Okay.
Mark, My question is about how a loan officer could potentially help someone who had an FHA borrower due to maybe a lower score. How can that loan officer help someone get a higher credit score?
Well, we have a credit simulator program that we run here, which basically says, you know, this is the score that we're looking for, and our computer tells us exactly what that customer would need to do to get it. And in many cases, it could be something very small. In some cases, it could be taking a credit card from a balance of $500 to $250 can impact someone's score by 21 points. Sometimes it's removing, you know, taking a credit card that's in dispute and taking it out of dispute, or vice versa. Disputing a late charge that's on your credit report can have a 20 or 30 point impact on your score. So really what it is we have a computer system that tells us what things people can do to improve their scores. And sometimes it's a 2 or 3 step process depending on how big a jump we're looking for. But it is also something that can be done within, you know, 2 or 3 weeks time in a lot of cases, especially if that person has some money to play with.
Thank you.
Yeah. What other questions can I answer for you guys? Well, listen, if you want to have more of a one-on-one conversation, you can email me at the email address mgordon@princetonmortgage.com. My cell phone number's over there. You also have my office line. I'd love to talk to anybody who has any individual questions and work with you guys. Thank you so much for coming. I sincerely appreciate it. I plan on doing more of these in the future. So if you enjoyed it and you have some other people that you think might enjoy it as well, please invite them, bring anybody that you'd like. At Princeton, we are a very transparent company, and we share all of our information, not only with you guys, but with all of our employees. And so we expect and would bet that our staff is as educated on these things as any other team in the industry. And so whichever loan officer you have you met before that ended up having you get invited here, you should also be able to reach out to them and get a lot of this information as well. Thank you guys so much for coming, and hopefully we'll talk to you guys again soon.
Yeah, thank you guys for joining us today. As I mentioned earlier, I'll make sure to get out the PDF and also a recording of the webinar so you can reference it as you would like. Cool.
Thank you.
I have a question if Mark's still around. I do have a question.
Laura,
Hi,
go
Mark.
ahead.
Thank
Laura.
you. Hi. So thanks for your webinar. My husband and I are we're not realtors, but we're looking to invest in an investment property right now. And you mentioned that it's a good time to refinance, but is it a good time to get into the market right now, or should we wait?
So 2 things. One is, if you're going to buy an investment property now, you should make sure that you would be able to cover that payment and qualify if your renter doesn't make their payments or if you're unable to rent it. Your mortgage company is certainly going to make sure that you can do that, as well as you guys should do that for yourselves.
Yeah, when we can do that. That's like,
Yeah.
we checked that box.
So the second piece of this is I think it really depends on the individual opportunity and the market that you're looking in. You know, for me, I would feel very comfortable buying right now if it was something that I needed to buy, or something that that if there was a reason for it and I could look in a specific area and feel really good about it. From just a strictly investment decision, I think I would only do it assuming that I could make an offer that seemed reasonable to me. Maybe I thought I was getting away with something or stealing something because of the situation, then it would make sense. I don't think I'd be paying asking price for anything right now as an investment.
Right. Thank you.
I think it should be, this situation, especially in most markets, should give buyers leverage. And so you should be using that if you're going to invest.
Okay. Thank you.
Yeah. And the realtors probably all just got really mad at me because I gave real estate advice, but ask your realtor. Ask your realtor. But what other questions do you guys have? Anything else at all? Well, you guys certainly know where to find me if you need anything. Thank you again so much for coming. And like I said, we'll do another one of these sometime soon. Thanks so much.
Thanks, Mark.
Thank you, Mark.
Thank you, Mark.
Bye, everyone.
Bye, guys.
Be safe.